Hold on to your calculators, tax warriors. We're diving into the anxiety-inducing world of realizing that maybe you owe the IRS more than you expected. It's a feeling that ranks right up there with spotting flashing blue lights in your rearview mirror or hearing the dreaded "you need a root canal" from your dentist. Yikes. But never fear, we're here to help you figure out why your tax bill makes your heart sink, and more importantly, how to avoid that sinking ever again. So buckle up, grab your favorite beverage, and let's get to the bottom of that pesky question: why do I owe taxes this year? By the way, if you're enjoying this tax-tastic ride so far, don't forget to smash that like button and hit subscribe. And while you're at it, why not ring the bell for notifications too? After all, who wouldn't want to be alerted the moment we drop more tax knowledge bombs? Many of you are probably wondering, why do I owe taxes this year? Imagine this: you've been getting tax refunds all your life, and suddenly you're cutting a check to the IRS. What sorcery is this? Well, it's really simple math. You owe more taxes than you paid throughout the year, which usually means you didn't withhold enough from your paycheck. But finding the specific reasons for owing Uncle Sam can be a little bit trickier. Let's dive into the 7 common culprits behind your tax woes. Reason number 1, your tax withholding is off. Remember that W-4 you filled out when you got your new job? You know, the one you scribbled on between handshakes and bathroom breaks? That form determines how much your employer withholds from your paycheck for taxes. If you didn't get those details right, your tax withholding might be off. So how do you avoid this tax snafu? Double check your W-4 and make sure it's up to date. And while you're at it, give your paycheck a once over to ensure you're not giving the IRS an interest-free loan by overpaying your taxes. Reason number 2, you owe taxes on self-employment income. Starting a side gig is a fantastic way to showcase your entrepreneurial spirit, but don't forget the tax implications. As a self-employed individual or independent contractor, you'll need to reserve approximately 25 to 30% of your earnings for taxes. Additionally, you're responsible for that lovely 15.3 self-employment tax, which covers Social Security and Medicare. To avoid a surprisingly large tax bill and potential penalties from the IRS, it's crucial to pay estimated quarterly taxes throughout the year. By staying on top of your tax responsibilities, you can ensure your side hustle remains a profitable and rewarding endeavor. Reason number 3, the child tax credit changed again. In 2021, Uncle Sam gave parents a sweet treat with the American Rescue Plan. The child tax credit got a major facelift. It was bigger, it was better, and even landed in your bank account monthly. Let's hit that rewind button and see what all the fuss was about. First, we had a major size credit, $3,600 for kiddos under 6 and $3,000 for kids between 6 and 17. Second, it was totally refundable. Yep, you got the whole shebang, even if it was more than your tax bill. Third, there were monthly payments. Hello, early Christmas. The IRS sent half the credit in advances from July to December of 2021. The rest was claimable on your tax return. But hold up, party people. The good times were kind of short-lived, and 2022's got some interesting changes. Here's the lowdown on this year's child tax credit. It's only $2,000 per qualifying child under 17. Yep, we're back to square one. Is it refundable in the sense that if your credit amount is more than your total tax liability, the difference can be paid back to you as a refund? Well, let me give you an example. If your tax liability is $1,000 and your child tax credit is $2,000, a fully refundable credit would allow you to receive the entire $1,000 difference as a refund. However, for the 2022 tax year, the child tax credit is only partially refundable, up to $1,400 per qualifying child. This means that even if your tax liability is less than your credit, you can only receive a maximum refund of $1,400 per qualifying child. And this refundable portion is also, of course, subject to income limitations. And lastly, those child tax credit monthly payments some of us were enjoying in 2021 are obviously gone. So those are the major changes related to having children and taxes. Reason number 4, you went through some life changes. Life can be a roller coaster. Marriages, career shifts, babies, and kids growing up. All these life changes can impact your tax situation, sometimes for the worse. Whether it's losing the child tax credit or having to pay unemployment benefits, life has a funny way of messing with your taxes. Reason number 5, you qualify for fewer tax deductions. When you can't claim as many tax deductions, your tax bill may be on the rise. For instance, if you finally paid off your student loans, you can no longer claim the student loan interest deduction, which could increase your tax bill. Similarly, if you've downsized to a smaller home with lower property taxes or mortgage interest, you might see a reduction in those deductions as well. And let's not forget about work-related expenses. If you are no longer working from home, you might not be able to claim some of the home office deductions you enjoyed in the past. All of these factors can add up, making your tax bill higher this year. Reason number 6, you moved into a higher tax bracket. As your income increases, you may find yourself in a higher tax bracket, which means you'll be subject to a higher marginal tax rate on a portion of your income. The U.S. federal income tax system uses a progressive tax structure with multiple tax brackets that apply different tax rates to different portions of your taxable income. Talk about a mouthful. For example, let's say you were in the 12% tax bracket last year, but received a significant raise or experienced a large increase in income from other sources. This increase could push you into the 22% tax bracket. While only the income above the 12% bracket threshold would be taxed at the 22% rate, this could still result in a higher overall tax bill. It's important to note that moving to a higher tax bracket does not mean that all of your income is taxed at that higher rate. Only the income above the threshold for that bracket is taxed at that higher rate. However, the increased tax liability can still catch you off guard if you haven't planned for it. To avoid surprises, consider adjusting your tax withholding or making estimated tax payments to cover the additional tax liability. Reason number 7, you owe capital gains tax, aka when your investments get a little too spicy. If you're out there buying and selling investments, trying to make a quick buck, and those investments include anything from cryptocurrency, single stocks, ETFs, or real estate, you're going to have to report those gains or losses on your tax return. And you know what? The IRS has a special tax for investors called capital gains tax. Short-term capital gains on assets owed less than a year are taxed at your regular income tax rate. Long-term capital gains on assets you've owned longer than a year are taxed at a lower rate. So there you have it, tax warriors. We've conquered the tax-tacular realm and emerged victorious. We've dissected the most common reasons why you might owe taxes this year, from withholding woes to pesky capital gains tax that pops up when your investments get a little too spicy. If you found this tax voyage as thrilling as a high-speed car chase down the freeway with no flashing blue lights, of course, then go ahead and smash that like button and subscribe for more tax extravaganzas. And hey, while you're at it, ring that notification bell to be the first to know when we drop even more tax knowledge bombs. Until next time, happy tax season and stay money smart.